So here we are starting one of the very important topics in your syllabus, that is titled as long-term financing decisions, LTFD. I don't know about you, but I am super excited to discuss this topic with you, because this topic is the backbone of financial management. Somebody not knowing anything about long-term financing decision means doesn't know financial management. So financial management is all about developing skill on long-term financing decisions. I would want you to take note of some important theory before I start talking about this, and once you have written that theory, I'll begin my explanation. The theory which I'm asking you to write is something really important. So just do one thing, take note of those points and don't bother about the understanding aspect. First you write and then I'll provide the necessary explanation. Please write, there are 4 different sources of long-term financing: debt, preference shares, equity shares and retained earnings. The aggregate of the above 4 factors is known as total capital employed. Total capital employed by equation can be considered as debt plus shareholders' funds, and debt represents all long-term borrowings including debentures and bonds issued by the company. Let us move ahead and write up some additional notes further. So please write, shareholders' funds equals to preference shares plus equity shares plus retained earnings. And then you write a very important paragraph. The objective of the company is to design optimal capital structure. In other words, to design best possible mix of the 4 sources of long-term finance. An optimal capital structure is such a capital structure which can maximize the rate of return for equity shareholders, or an optimal capital structure is such a capital structure that can minimize the overall cost of capital. Let me explain what all we have discussed by far. Now actually speaking, we are attempting to learn a very important concept in finance that is titled as long-term financing decisions. If you can recollect, the first statement that I would have mentioned in financial management, the first statement, what was that? Financial management is a study about how an entity will arrange its funds and how an entity will utilize its funds. In simple words, it is a study about arrangement and utilization of funds. And when we talk about arrangement of funds, we have 2 aspects: short-term arrangement of funds, which we are going to cover up in working capital topic, and then long-term arrangement of funds, which we are discussing now under the title long-term financing decisions. I am sure you recollect that initial class on financial management. Now, when we talk about long-term financing decision, please understand first of all that there are 4 components of capital. In other words, there are 4 sources from which you can arrange funds: debt, preference shares, equity shares and retained earnings. Let me explain the meaning of each of these 4. Debt, the word D-E-B-T, debt, indicates borrowings, but necessarily long-term borrowings. So these are all kinds of long-term borrowings. If the company has issued any kind of bonds or debentures, even that is considered as a debt. So here, all components of borrowings, whether they are secured or unsecured, whether these borrowings are from banks or some NBFCs or private lending institutions, or they are borrowings from individuals, or they are borrowings in the form of debentures and bonds, all these are classified under one category, called as debt. For a company, a debt component is an external fund because the company's shareholders will contribute their money, and if they find that this contributed money is not enough to run the business, they might end up arranging money from external sources, that is typically known as debt. So debt is one such source of long-term finance. Other two components that I have mentioned in the list, preference shares and equity shares. I am sure you people have been learning about preference shares and equity shares right from the point when you have started learning accounting, right? So what are preference shares? What are equity shares? You know it very well. Preference shares will always be having preference over the dividend. Means the company will have to first provide dividend to preference shareholders, then out of the remaining profit, dividends can be given to equity shareholders. You know it. But the disadvantage of holding a preference share in a company would be, irrespective of the profit earned by the company, the preference shareholder will be given a fixed rate of dividend. On the other side, whatever is the residuary interest, means whatever is the residual profit after payment of preference dividend, all comes in the hands of equity shareholders. In fact, in earlier classes, when we have learned preparing income statement of a company, do you recall that from the amount of profit after tax, the first dividend goes to the preference shares, and what we get as a balancing figure is earnings available to equity shareholders, and from that when you give away equity dividend also, the remaining portion of the earning is what we call as retained earnings. That portion of earnings that stays in the balance sheet of the company, which is not distributed, and it is held, it is kept as a reserve for future growth. So what is the advantage of equity shareholder in a company? These are the true owners. They are not having certainty of receiving any dividend, but whatever profit company earns, everything after the distribution to outsiders, whatever remains belongs to equity shareholders. Second advantage of equity shareholders, it is these are the members who have voting power. In the company's decision making process, that contributory which gets involved actively is none but equity shareholders. So these are, because the true owners of the company, the maximum risk of the company's business also falls upon equity shareholders. So friends, I have discussed that there are four components of long-term capital or long-term sources of finance. One is debt, one is preference share, one is equity share. I have not given much detailed discussion on equity share and preference share because it will be unnecessarily becoming a boring discussion, because I am knowing that you know very well what are preference shares and equity shares. The fourth component, that is retained earnings. Let me explain what are retained earnings. As I told you, suppose company has earned a profit of rupees 10 lakhs, out of which suppose 1 lakh was given away as preference dividend and 2 lakh was given away as equity dividend. So the net profit after tax was 10 lakhs, of which preference dividend, equity dividend taken together, the total distribution to shareholders was 3 lakhs. What remains with the company is 7 lakhs. That 7 lakhs is retained earnings. What is the real meaning of retained earnings? That portion of profit on which there is no charge, on which there is no expectation of anyone, that portion of profit which is meant only as availability to equity shareholders, but you haven't distributed, that portion of profit which is undistributed profit which remains with the company as a reserve is known as retained earnings. So beta, what is our objective in this chapter, long term financing decision? Think from a broader perspective. company has to design a capital structure. So because there are 4 sources, you have to smartly make a mix of these 4 sources. Smartly making a mix of these 4 sources means how much of debt, how much of preference share, how much of equity share, what should be the portion of retained earnings. You have to plan it very well. That is what we call as designing an optimal capital structure. So capital structure means the composition of capital, how your capital is going to be composed of out of these 4 sources, how much should be the fund contributed by each source. That is your objective, designing an optimal capital structure. So now we have one objective, that is designing an optimal capital structure. We have 4 sources of long-term finance, and we have various factors that we have to consider for achieving our objective. One such factor is maximizing the rate of return to the owners of the company. The real owners of the company are only and only equity shareholders. So to provide a maximum rate of return to equity shareholders is one of the primary objectives, and therefore we can say an optimal capital structure will be such a capital structure that can maximize the rate of return for equity shareholders. Now when we are arranging these money, when we are arranging this capital from multiple sources, we are going to incur some cost towards that, because the moment you borrow money, you commit yourself that you will pay interest on borrowings. When you are raising funds through preference shares, you are promising them to provide some rate of preference dividend. When you are arranging money from equity, you are giving them expectation, you are giving them hope that you will be earning profit for them because they are owners of the company. Though you have no fixed commitment towards equity shares, but because they are owners of the company, they have invested their money with some expectation, and whatever be shareholders' expectation, that becomes obligation of the company to fulfill. Simply tell me, you people are my students, right? Don't you agree that you have some expectations from me, that you would want to learn concepts of finance with complete smoothness? If that is your expectation from me, your expectation indeed becomes my obligation, because if I have to make you happy, I have to fulfill your expectations. To fulfill your expectation, I have to work towards it, and that becomes my obligation. In other words, if you relate it the same aspect in company, if the company has raised money from its own owners who are equity shareholders, company hasn't given any fixed commitment to them, but these equity shareholders, the owners of the company, they have invested their money in the company with an expectation to get some returns, and fulfilling that expectation becomes company's obligation. Now tell me one thing. What we are talking about is aggregate of these 4 sources: debt, preference shares, equity shares, and retained earnings. Aggregate of these 4 sources is what we call as total capital employed. Out of this total capital employed, if you keep aside one segment, that is debt, the other part, the aggregate of the other 3, that is preference shares, equity shares, and retained earnings, those are termed as shareholders' funds. So you can split the total capital employed into 2 categories: debt fund and shareholders' funds. Debt fund indicates debt, shareholders' funds indicate aggregate of 3, that will be preference shares, equity shares, and retained earnings. Aggregate of all the 4 components is total capital employed. So I would say total capital employed equals to debt plus shareholders' funds, or total capital employed equals to debt plus preference shares plus equity shares plus retained earnings. And what is our objective? I am reminding you again, we have to design such a capital structure which can be identified as optimal capital structure. So I am sure whatever we have discussed by far, you have understood very well. Now time for us to move to questions. What I will do is, on the screen I'll be displaying questions one by one. In this chapter, my humble request to all of you, don't rush up with solving a question. Go slow, use your minds. When I'm giving you some time to try out some calculation, don't waste that time. Actually put efforts, try out that calculation. If you can calculate the answers before I display the same on screen, that is what is really needed by me. That will be my expectation from you. If your expectation becomes my obligation, my expectation also should be taken care of. Let us begin with question number 1. Let us read this question. The capital structure of NJ Limited comprises of the following: 12% debentures rupees 10 lakhs, 8% preference share capital rupees 10 lakhs, equity share capital rupees 20 lakhs, that is equity shares of rupees 10 each. So 20 lakhs of capital is composed of each equity share of rupees 10 each. With this you can work out that the number of equity shares that the company has issued must be 20 lakhs divided by rupees 10, that is 2 lakh equity shares. Thereafter what we find is other details. Sales are given as 30 lakhs, fixed cost is rupees 4 lakhs, variable cost is 60% of sales, and tax rate is 40%. Prepare income statement and calculate the following. Number 1, rate of return on capital employed. Number 2, rate of return on shareholders funds. And number 3, rate of return for equity shareholders. So basically what we are supposed to do is, we are supposed to make an income statement first of all, and then compute these 3 different types of rate of returns. Now how to prepare income statement is what you have already learnt. However, how to compute these 3 types of rate of returns you haven't learnt earlier. So when I am discussing these calculations, you need to understand it very clearly. As far as preparing income statement is concerned, it is an easy task. Let us do that thing first. So in your solution, you get started with presenting an income statement, and we start with sales. Sales is reported to you as 30 lakhs less variable cost, which is 60% of sales. That will be 60% of 30 lakhs, that is 18 lakhs. From sales, when you subtract variable cost, you get contribution 12 lakhs. From that you subtract the fixed cost, and what you get is earnings before interest and tax, EBIT. Now you know one thing, earnings before interest and tax is also termed as operating profit of the company, which is 8 lakhs. From this you are first going to subtract the interest on debentures. So interest on debentures, it will be 12% of 10 lakhs, which will be 1,20,000. From that you get EBT, that is earnings before tax. From earnings before tax, you have to subtract the amount of tax. Tax rate is given as 40%. So your tax obligation will be 40% of your taxable profit. That will be 40% of 6,80,000. That comes to 2,72,000. Subtracting this, you would be getting profit after tax as 4,08,000. One small point of concept over here, you should know one thing very well. If tax rate is 40%, profit after tax is obviously going to be 60% of profit before tax. You know it very well. Now, from the amount of profit after tax, we are going to subtract preference dividend, because it is preference shareholders who will be first having the right to receive dividend. So preference share nominal value was 10 lakhs, 8% was the committed dividend. So irrespective of the profit earned by the company, what happens is you are going to provide preference shareholders 8% return on the money that they have contributed. That is 8% of 10 lakhs, that is rupees 80,000. Whatever remains is termed as earnings available to equity shareholders. This earnings available to equity shareholders will be divided by number of equity shares to arrive at earnings per share, which will be rupees 1.64 for each equity share. I am sure all of you have clear understanding about this income statement and all the components of this. Now, before we go for the calculation of those different types of rate of returns demanded in the question, please understand this discussion that I am having with you. The first type of rate of return that is demanded, it is rate of return on capital employed. This is the overall rate of return on the entire capital employed. Whether the capital is arranged from debt or equity or preference share does not matter. You are clubbing up the whole capital employed. You are saying that if this much money is given to this company, how much income it can generate in the form of operating profit. To compute this rate of return, the numerator will be earnings before interest and tax or operating profit, and the denominator will be total capital employed. So I repeat one thing, this rate of return indicates the return generating capacity of the company, because if company is doing some business, if you provide them money, irrespective of what is the source of that money, the company will put that money into its operations or into its business and generate some income in the form of operating profit. What is the rate of return generating capacity of that company on its capital employed? That is called rate of return on capital employed. Second type of rate of return, what is asked in the question, it is the rate of return for shareholders. Now when I say shareholders, commonly it is equity shares, preference shares combined. So equity shares, preference shares combined, you have to identify which component of profit will belong to them. So EBIT does not belong to them because interest is yet to be paid, tax is yet to be paid. So the profit that belongs to equity shareholders and preference shareholders jointly, or profit that belongs to shareholders as such, is the net profit after tax. So to compute the rate of return for shareholders in general, the numerator will be profit after tax, denominator will be total shareholders funds, where equity, preference, retained earnings, all components will be considered. And then whatever rate of return you get, that will be the rate of return for shareholders in general. But the third rate of return demanded in the question is one of the very, very important calculation. That is the rate of return for one specific category of shareholders, that is equity shareholders. Irrespective of how much profit is generated by the company, the preference shareholders will be given a fixed rate of dividend. Correct? So you have decided to give 8% dividend to preference shareholders in this case. Whatever earnings have remained, all those earnings eventually belong to only one category of contributory, that is equity shareholders. So the third rate of return what you are going to calculate, it is rate of return for equity shareholders. To do that calculation, the numerator will be the entire earnings available to equity shareholders divided by the total equity shareholders funds. So here in the denominator, you will take equity share capital, you will take retained earnings because even that belongs to equity shareholders, but you will not include preference shareholders. You will not include preference share capital also, nothing. So I am sure you have understood these three rates of returns. Let us do one thing. Let us apply those calculations and determine those rate of returns. I am showing the calculation on screen. Please carefully take note of the same. Number one, rate of return on capital employed, ROROCE. It will be EBIT divided by total capital employed into 100. That will be 8 lakhs divided by 40 lakhs into 100. That gives you 20%. What is the interpretation of this rate of return? You should understand it very well. Whatever money you provide to this company from any source, but this company's business is capable of generating 20% operating profit on the money provided. So because this company has raised a fund of 40 lakhs in total, its operating income on a net basis, which we call as operating profit or EBIT, it is 20%. On 40 lakhs, it has generated operating profit of 8 lakhs, which indicates 20% return generating capacity of the company. When we come to rate of return on shareholders' funds, I have already explained you have to take that component of profit which is available for shareholders in general, which will be the net amount of profit after tax or simply profit after tax. This will be divided by total shareholders' funds. When I say total shareholders' funds, it will be equity shares plus preference shares aggregate. And this rate of return comes to 13.6%. So if you want to differentiate between the first one and the second one, you can say the first rate of return, that is rate of return on capital employed, it indicates the return generating capacity of the company before interest and tax, that is in terms of operating profit. However, the second rate of return is what truly the shareholders of the company are earning. Let us move ahead and write up the third rate of return, that is rate of return for equity shareholders, and here it will be earnings available to equity shareholders. Only that portion of earnings which is available to equity shareholders will be taken as the available profit, and the denominator will be only and only the funds belonging to equity shareholders. Actually, equity shareholders funds over here necessarily mean the aggregate of equity share capital and retained earnings. Because in the question there was no information about retained earnings, we are obviously going to take only and only equity share capital amount, which is 20 lakhs in this case. So this rate of return comes to 16.4%. Now over here, generally students were asking doubts that, sir, why are we computing two separate rate of returns for shareholders, the second one and third one? The second one which was commonly for all shareholders, third one typically for equity shareholders. Some students also had doubt that, sir, why are we even computing that second rate of return, because as such we have nothing to do with that. So I first of all understand your point, and let me clarify one thing on this. The second rate of return we have computed basically because the question has asked. Secondly, what is the utility of that rate of return? If you want to know, we would want to generally know that how much profit company is able to provide to its shareholders in general, not distinguishing equity and preference. Combined, all owners taken together, all shareholders taken together, what is the rate of return? Practical utility is more with the third calculation, that is rate of return on equity shareholders funds. But if you use your brain over here, you will be able to connect the missing dots, and that is a lovely thing in financial management. Please focus on what I am trying to say. These things I would have actually discussed at a much later stage, but I am sure you will be able to at least connect the concepts. Please listen to me. So equity shareholders and preference shareholders funds taken together, it was 30 lakhs. 30 lakhs arranged from them, and 13.6% is the return that we are generating commonly for shareholders. One category or one segment of such shareholder is preference shareholder also. To preference shareholders, you have shown that, see boss, the rate of return we have generated for shareholders, it is 13.6%. Preference shareholders get so happy. When they come and collect the dividends, you are giving them only 8% dividend. So what is happening? From their money, you have earned 13.6% net of tax, but to them you have paid only 8%. How much is the surplus that you have retained? 5.6%. That 5.6% will be adding to the rate of return for the shareholders. However, it is not 5.6 that gets added directly, because logically the capital amount of preference share was 10 lakhs, but capital amount of equity share is 20 lakhs, double the amount. So 5.6, if you divide it by 2, what you get is 2.8%. That 2.8% you add to 13.6. Do that on your calculator and check. If you do it correctly, 13.6 plus 2.8 will give you 16.4, which is actually the rate of return for equity shareholders. So why equity shareholders are able to earn 16.4%? I have tried to analyze and shown you that reconciliation. If you don't understand through rates, let me give a more elaborate explanation on the same. Please understand this point. Amount contributed by preference share is 10 lakh. Amount contributed by equity shares is 20 lakhs. 20 lakhs by equity, 10 lakhs by preference. On all of these funds, you have earned 13.6%. Can you compute 13.6% of 10 lakhs? It will be 1,36,000, and 13.6% of 20 lakhs, it will be 2,72,000. On this 1,36,000 of profit, you distributed only how much? You distributed only 80,000 as preference dividend. So how much is the surplus? Surplus that you have saved from there is 56,000. So if I take my calculator, once again I'll show. First of all, you need to understand that 10 lakhs of preference share capital, on that you have earned 13.6%. In general, rate of return for the shareholder was 13.6%. So that makes it 1,36,000 as earnings that you have made from the funds of preference shares, which is 1,36,000. From that, how much dividend did you pay to them? 80,000. So what is the surplus left over? 56,000 is the surplus left over. Keep in mind, 56,000 is the surplus left over. Now let us come to the other segment, that is the segment of equity shares. Here the fund contributed by equity shares was 20 lakhs. On 20 lakhs, if I compute 13.6%, I am definitely getting 2,72,000, twice the amount of preference shares, correct? So 2,72,000, and there was a savings from preference shareholders funds, because that earnings which we have made, we did not pay that much dividend to preference shares, we have paid only 8%. Whatever surplus you have saved over there will actually boost the earnings for equity share. So this 2,72,000 what I am getting as earnings commonly for this equity shareholders, on this if I add 56,000 of that surplus earnings, what do we get is 3,28,000, which becomes earnings available to equity shareholders. This I divide by 20 lakhs, and when I compute it as a percentage, what I get on my calculator is 16.4%. What I tried to discuss with you, we are going to learn ahead also, but if you can understand this, it will be a wonderful thing. So beta, some people may think that why are we mixing all these funds? Why don't we keep it pure equity financing? Why don't we keep it pure equity financing? What would have happened if we keep pure equity financing? So you can actually try out once again solving the whole question, assuming that entire 40 lakhs was contributed only and only by equity shareholders. That means we don't have preference share capital, we don't have debentures, we have pure equity funding. Try doing that. Try what you get over there. You want to really give a try? Let's do it. So what I have asked you to do is, What will be your answer to question 1? If the entire capital employed of rupees 40 lakhs is financed only by equity shares, so that will be 4 lakh equity shares of rupees 10 each. Let us see what will be the outcome when you are presenting income statement under this possibility. Sales does not change, variable cost does not change, contribution does not change, fixed cost does not change, and therefore EBIT does not change. One thing, no matter what changes you make in your capital structure, this much segment of your income statement will never change. Then what is happening? Interest becomes 0, correct? So what we get is EBT same as EBIT, so EBT is 8 lakhs. So from the earnings before tax, when you subtract tax, that is at 40%, tax will be now 40% on entire 8 lakhs. Can you notice one thing? Because you have no interest expense, you have more amount of profit arising as earnings before tax, and therefore the amount of tax also increase. Anyway, the profit after tax 4,80,000, you have now no commitment towards preference shares also, because you have not raised any money from preference shareholders. So all your profits are available to equity shareholders. And now number of equity shares are 4 lakh shares. So earnings per share will be rupees 1.2. Let us move ahead and now compute those rate of returns. So rate of return on capital employed does not change at all. It will remain same. I already explained you this fundamental point, that this will not change. It was 20% earlier, it will be 20% even now. However, the rate of return on shareholders funds definitely will change. What will be the rate of return on shareholders funds? Do you know? It will be reduced to just 12% this time. So earlier in the original part of the question this was 13.6%, but now here it is only 12%. Let us move ahead and compute the third rate of return, which is rate of return for equity shareholders. Because all shareholders are equity shareholders only, what happens is only the formula changes over here and the calculation indeed remains same, that is 12%. Now over here I want to offer one very important concept and a very important clarification. Have you noticed one thing? When you are arranging your entire capital only from equity, what is happening? The rate of return of equity is dropping down to just 12%. In fact, without making income statement, you could have done that in a moment. The moment I ask you a question, instantly you could have answered if you have this approach what I am going to explain now. First fact, you change the composition of capital, your rate of return on capital employed will not change. That will remain static, because if capital structure changes, sales, variable cost, contribution, operating fixed cost, these will not change. If these do not change, it is obvious thing that your calculations, I repeat, your calculations of rate of return on capital employed will not change. Now, how much operating profit are you generating on your capital employed? 20%. Use your brain. Rate of tax is 40%. What does that signify? Whatever money, whatever returns you earn, 40% of that you have to pay as tax, correct? So imagine before tax, if you have generated 20% returns, after tax your returns will be 60% of profit before tax, and 60% of 20% is nothing but 12%. I repeat, 60% of 20% is 12%. If you are getting confused, let me clarify once again. Tax rate is 40%. So whatever returns you get post tax will actually be 60% of the returns before tax, and return on capital employed, ROROCE, that is rate of return on capital employed, is basically rate of operating profit, which is a rate of return before tax. If before tax rate of return is 20%, tax rate is 40%, so post tax rate of return will be 60% of the pre-tax rate of return. So 60% of 20 is nothing but 12. If you have heard me clearly, if you have carefully listened to this whole explanation, and if you have common sense, you would definitely understand that the moment I say that only equity financing, the rate of return on equity will drop to 12%. But do you know what was the reason why equity rate of return originally in our question was 16.4%? It is because of outsiders funds being used. Debenture was a segment where you have again earned 20% on that fund. But do you know, if you have earned 20% on that fund, you have given interest of only 12%, some savings from them. In fact, the savings on the preference shareholders funds I have already reconciled by percentage and discussed that with you. All this taken together, the shareholders funds, that is equity shareholders funds, being only 20 lakhs, the rate of return will enhance, not because of the earning potential of the company, but smart capital structure designing. Boss, beyond the point, you cannot enhance the profit from a business. But if you smartly have a mix of capital structure in your company, what will happen is you can keep using outsiders funds, you can earn more money from that, pay less to them, and save some surplus for your equity shareholders. This is where we say that company is working on leverage. Company is working on a financial leverage. Do you know what is the meaning of financial leverage? Using outsiders funds, using borrowed money, earning through that and enhancing the rate of return for your equity, that is what we call as financial leverage. But financial leverage will be beneficial. Do you know when? Financial leverage will be beneficial when you are able to earn a rate of return more than the rate of interest that you commit to the debenture holders. You are able to earn more and the rate of dividend that you have committed to preference shareholder is less. That is where you start gathering surplus from these contributories, and all that surplus will be accumulated and passed on to your owners, that is equity shareholders. This is how you enhance the rate of return on your equity shareholders funds. So with this understanding, the next leading concept that I am going to discuss is the concept of leverages. So please write the next heading in your notebooks as leverages. After you have written this heading, that is leverages, if you can recall what you have learnt in the previous example, if you can recall, we have seen two types of capital structures in the same example. The first original information was a mixed capital structure and the second one was pure equity. So the pure equity type of capital structure, we call that as unlevered capital. Unlevered means leverage is not there. The first one where debt, preference share, these components were included, we call that as it is a levered capital, or it's a capital with financial leverage. So that is what we are going to learn next under the heading leverages. Leverages are actually such measures which will help you to identify the business risk. So it is one thing very clear, any business will take risk. That business risk is primarily classified into two segments, operating risk and financial risk. Operating risk is all relating to operating fixed cost and financial risk is all relating to borrowings. So please carefully understand one thing. Under the study of leverages, we will be talking about business risk. Business risk is primarily classified into two segments, that is operating risk and financial risk. If you carefully look at your income statement, carefully, if you can even visualize that income statement without me showing it over here, you know how do you prepare income statement? You start with sales. From sales, you subtract variable cost. What you get is contribution. From contribution, you subtract operating fixed cost. I repeat, throughout this chapter, from contribution, we will not subtract all fixed cost. We will subtract operating fixed cost only. Operating fixed cost will include depreciation and amortization, but will not include interest. So, from sales, you subtract variable cost, you arrive at contribution. From contribution, you subtract operating fixed cost, you arrive at EBIT. Then you subtract interest to arrive at EBT. Then you subtract tax to arrive at profit after tax. And then you subtract preference dividend to arrive at earnings available to equity shareholders. From sales to earnings available to equity shareholders, if you cross this whole journey from the position of sales to the position of earnings available to equity shareholders, do you know, you are just subtracting. Let me be very specific. You have subtracted 5 components that I just counted for you. First one was variable cost. Second one was operating fixed cost. Third one was interest. Fourth was tax. And fifth was preference dividend. Beta, if you carefully understand, risk does not arise because of all 5 components. Use your brain. Variable cost you will incur only if sales are made. If no sales, no variable cost, because the nature of variable cost, we have learnt earlier that variable cost will vary with sales. So if there are no sales, no variable cost. But your fixed operating cost you will be incurring irrespective of whether you generate sales or not. For example, if right now in this lockdown scenario, there will be certain expenses which the companies would be incurring irrespective of whether their factories are operating or not. But there will be substantial savings in lots of other expenses, all the variable expenses. If you are not producing the product, if you are not making sales, you will not incur variable cost. So variable cost can never create risk, but fixed operating cost will always be a risk factor. Next component is interest. Will interest create risk? Yes, interest will create risk. Why? Because whether you earn profit or not, whether you are able to make sales or not, you will have to pay interest on your borrowings. But after interest, what is the next component? Tax. Tax can never create risk because you will pay tax only if you earn profit. If you are incurring loss, you don't have to pay tax. Next component is preference dividend. Even that cannot create risk because it can create risk only if you have a commitment to pay preference dividend whether you earn profit or not. But that is not the case. You will pay preference dividend only and only out of your profits. So if profits are not available, you don't pay preference dividend. Once again, from sales, you subtract 5 components. You subtract first thing as variable cost to get contribution. Then you subtract second thing, operating fixed cost to arrive at EBIT. Then you subtract interest to arrive at EBT. Then you subtract tax to arrive at profit after tax. And then you subtract preference dividend to arrive at earnings available to equity shareholders. 5 components subtracted from sales and you land up at earnings available to equity shareholders. When you analyze each one of these 5, only 2 of these create risk. Other 3 will never create risk. So the 2 which are creating risk are operating fixed cost and interest. Operating fixed cost will result into operating risk, and the other component which is also fixed cost, but we don't put it along with fixed cost, we call it separately as interest cost. Interest cost, just like fixed cost, it will also create risk, because by nature it is indeed a fixed component of cost. Whether you make sales or not, you will have to pay interest. But I told you earlier also, with preference dividend, that is not the case. If you don't make sales, if you don't earn profit, you don't have any obligation to pay preference dividend. You don't have any obligation to pay tax. So, only two factors create risk: fixed cost, that is fixed operating cost, and interest cost. These two components create two different types of risk. One is operating risk, one is financial risk. Now, the first thing that we will do is we will measure operating risk and financial risk. Operating risk is measured by a ratio called degree of operating leverage, and financial risk is measured by another ratio called degree of financial leverage. So once again, what I'll do is I'll give you some important notes to write down, and then I will go ahead and explain the same with examples. So only when calculative examples come into picture, your understanding gets better. So let us write some notes and then we shall move ahead. Under the heading leverages, please write: business risk can be classified into the following: operating risk and financial risk. Operating risk arises because of existence of fixed operating cost, whereas financial risk arises because of existence of debt in the capital structure. In other words, financial risk arises because of existence of interest cost. So what we do now is I take you ahead and you would write some additional notes. Operating risk is measured by a ratio called degree of operating leverage, that is DOL. Now how to compute this? It is contribution divided by EBIT. The logic behind this calculation I will explain later. Right now you just write up the calculation base. Higher the degree of operating leverage, higher will be the operating risk. Financial risk is measured by a ratio called degree of financial leverage, that is DFL, and DFL is computed by this ratio, that is EBIT divided by EBT. Higher the DFL, the higher will be the financial risk. Let us move ahead and write some more notes over here. The overall risk in the business, which is combination of operating risk and financial risk, is measured by a ratio called degree of combined leverage, that is DCL, and DCL is measured by this ratio, contribution divided by EBT. DCL is the product of DOL and DFL. In other words, if mathematically we express this equation, DCL will be DOL into DFL. So if certain things remain uncleared, do not worry. The explanation will be coming up along with calculative examples. So let us move ahead and take up question number 2. Let us read this question. Capital structure of N Limited is given as below: 5,000 equity shares of rupees 100 each and 12% debentures. So 5 lakhs and 15 lakhs total capital employed is 20 lakhs. So here in this case we are finding only two components of capital: equity shares and debt. The variable costs are 60% of sales and fixed operating costs are rupees 10 lakhs per annum. Tax rate is 50% and you are required to prepare income statement for different level of sales amounting to rupees 30 lakhs, 35 lakhs, 40 lakhs and 50 lakhs. Calculate degrees of operating leverage, financial leverage and combined leverage for each of the above sales levels. So fine friends, what do we find over here? Two segments in the question. One that is asking you to compute leverages, that is the second part, and the first one is simply asking you to prepare income statement. So let us deal with the income statement thing first and let us see how to present the solution. So you can have a columnar presentation in your solution and you start with sales. Whatever be the reported sales value in the question, you just take note of that. From that you subtract the variable cost. Variable cost are given as 60% of sales. From sales, when you subtract variable cost, you would obviously get contribution. This time the fixed cost which is reported in the question is clearly given as operating fixed cost. So you don't have to be confused. When you subtract that operating fixed cost, what you will get is clearly earnings before interest and tax, or EBIT. From that, if we subtract interest, and I am sure you understand how we got this interest, it is 12% of 15 lakhs, and what we get now is earnings before tax, and from that if you subtract tax at 50%, what you get as the balance will be profit after tax, and the same thing we have written as earnings available to equity shareholders. Do you know when will profit after tax be fully available as earnings available to equity shareholders? When there is no preference share capital. That means whatever be profit after tax is fully available to only and only equity shareholders. Now number of equity shares, and what we get is earnings per share. And now time for us to have an important discussion over here with respect to leverages. So everyone's attention over here. Please carefully follow what I am trying to explain. This, what you are finding on screen, I am sure all of you would have attempted the calculations on your own and you would have definitely got this correct. You were not even dependent on me to deal with this. So in this second question, what you are solving right now, what is it that is new for you was the second part, that is computation of leverages. So when we are talking about calculation of leverages over here, you should first understand what is this leverage. First of all, when we speak of financial leverage, it is using the borrowed fund as part of capital. Basically, leverage means when you are using somebody else's asset for your benefit, it is what we call as leverage. Instead of you making your own investment, if you are using somebody else's asset, that is what we call as leverage. So please understand this point very clearly so that no one among you should ever have a doubt with the meaning of leverage. Let me give you example. Suppose I want to start my own coaching classes and I have to make or design an entire coaching classes structure, and for that I will need space. I have two choices. Either I can buy out that space and construct my classes over there, or I can take a property on rental basis. Taking a property on rental basis means I am not using my own money, I am using somebody else's asset in my business. Using somebody else's asset in my business is what going to give me position of leverage, because it is not my own resources that I am using, it is somebody else's resource. So same thing goes with money also. If it is my own money that I invest in my projects, fine. But if I am using borrowed money, means I am applying concept of leverage. So can you notice a difference? When I take a bank loan, means I have used borrowed money, that will create a position of leverage. We call that as a financial leverage. But when I have taken a property on rent, it is not a financial leverage. Taking a property on rent, it is an operating leverage, because that property does not belong to me. I am using somebody else's property for my business, but I have to pay a fixed charge towards that, what we call as rent, and for the bank loan that I have borrowed, I have to pay again a fixed charge that we call as interest. Whenever somebody else's resources that you are using creates a fixed charge upon you, towards either fixed cost, that is fixed operating cost, or interest, we call that situation as leverage. Leverage over here means you were not having your own resources, not to worry in the business, you can arrange it from somebody else and carry on your business. So you are taking a position of leverage, somebody else's resources you are using in your business. But why that somebody else will allow you to use their resources? Because you are paying them some charges, you are giving them some benefits by paying them rent, by paying them interest. So when you have taken a property on rental basis, it is an operating risk that you have taken, and when you have borrowed money, it is a financial risk that you have taken, because the interest on that borrowing you will have to pay whether you can generate sales or not, and the rent of that property you will have to pay whether you can utilize it or not. For example, in this whole COVID lockdown situations, do you know what is the problem with all the coaching institutes across the country? They have either their own place which is lying underutilized, or they have taken places on rent. Particularly where they have taken places on rent, they will have to pay rentals even though not a single student is arriving in the class. Because of this kind of lockdown restrictions, students are not coming to the class, but rentals have to be paid. So don't you think it's a fixed charge upon you, whether you generate income or not, the charge is upon you without any argument, you will have to incur cost towards that. Same way, in scenario, if you have taken bank loan, you will have to pay interest whether you are able to generate any income or not. So can you identify one thing? Fixed operating cost is giving you a position, or I would say fixed operating cost is giving you or is pushing you into a situation of risk. I repeat, fixed operating cost is pushing you to a situation of risk where the risk is operating risk. On the other side, the burden of loan, which is becoming a burden of interest payment, is pushing you to yet another type of risk, which is called as financial risk. So first of all, mentally be very clear with one thing: business risk classified into operating risk and financial risk. Operating risk arises because of using somebody else's resources other than money, using somebody else's resources and incurring fixed operating cost towards it. And financial risk arises when you are borrowing money, because that borrowing of money is imposing a commitment towards interest on that borrowing, irrespective of whether you are able to generate income or not. Because of these leverage positions, leverage is giving you a benefit that you are able to use somebody else's resources, but it is parallelly pushing you to a risky situation that even if you don't generate income, you will have to pay that fixed charge. Are you understanding that leverage is a benefit that we wanted to take, but no benefit in this universe comes free of cost? If a benefit in this universe is coming free of cost, it is just a God gift. Other than God gifts, no benefit comes free of cost. You have to practically incur cost for each benefit. So leverage position is actually a benefit, and because you are committed to incur cost towards that, that commitment creates risk. Now I have explained you meaning of operating risk, financial risk, and what is meant by leverage. Now through this table I will show you logically how to compute leverages. So I want you to just carefully pay attention on the same. Now look at the first column, that is case 1 over here, and please follow whatever I am explaining over here. Sales is 30 lakhs. Variable cost is always going to vary with the sales. If sales increase, variable cost will also eventually increase, and therefore contribution will also increase. However, if you could notice one thing with fixed cost, that is a fixed operating cost, in all the cases this is constant. So sales increasing or not increasing, sales decreasing or not decreasing, this cost is not going to change. So This is creating risk upon you. A cost that does not change becomes a fixed commitment, and that causes risk upon you. Just imagine if sales would have started declining below 30 lakhs and your contribution declines, what will happen? You may end up into a situation where your contribution is falling short of fixed cost, and that would give you at EBIT level itself a negative result, that is a loss. So basically, what is our objective? If this fixed cost is creating that risk, what is the value before fixed cost? It is contribution. And what is the value after the fixed cost? It is EBIT. So basically, fixed cost is a difference between contribution and EBIT. Can you notice one thing? Contribution minus EBIT can give you fixed cost, and it is fixed cost which is creating risk. But do you notice one thing? 10 lakhs of fixed cost here, as well as here. Where is less risk? Where is more risk? You are not able to identify. You know why? Because on absolute basis, all the amounts are same. That means the risk remains same. It is not changing in any case. However, have you noticed one thing? The absolute measure of risk doesn't change, but a relative measure of risk will definitely change. Can you notice one thing? If fixed cost is the gap between contribution and EBIT, the larger the fixed cost, the larger will be the gap. So if you take a ratio of contribution with EBIT, contribution divided by EBIT, that is 12 lakhs divided by 2 lakhs will give you answer as 6 times as degree of operating leverage. Do you know what does that 6 times mean? There are two different interpretations of that 6 times. First is contribution is 6 times of EBIT. That means to generate EBIT of 1 rupee, you need to generate 6 rupees of contribution, because the burden of that fixed cost on proportionate basis would be rupees 5. So every 1 rupee of EBIT would require 6 rupees of contribution. Therefore, the burden of that fixed cost is rupees 5. Let me take your attention to the last column now. The last column. Notice here also the fixed amount of cost is still 10 lakhs. But if you observe the relationship between contribution and EBIT, contribution is 20 lakhs, EBIT is 10 lakhs. That means if I take the ratio, that is degree of operating leverage, it will be contribution divided by EBIT. Contribution is how much? 20 lakhs, EBIT is 10 lakhs. This time degree of operating leverage does not go as 6 times, it is just 2 times. What does that imply? That your contribution is 2 times of your EBIT. That is one interpretation, which leads to a fact that if you want to generate 1 rupee of EBIT, you must have 2 rupees of contribution. So can you notice one thing? As and when your income is increasing, what is happening to fixed cost? Fixed cost remains constant. So with the increase in the income, what eventually is happening? Your capacity to bear the burden of fixed cost gets better and better. Your capacity to lift the load of fixed cost is improving. With your capacity of fixed cost burden bearing improving situation after situation, when you reach a point where contribution is 20 lakhs, bearing a burden of fixed cost of 10 lakhs appears to be no big deal. On the other side, when in the first column, when you are generating contribution of only 12 lakhs, spending fixed cost of 10 lakhs could be a heavy burden upon you. Imagine you would have been a small child someday, correct? Look around you, there must be some heavy equipment around you, okay? Some table, some chair, okay? Maybe a big wooden chair would be lying around you. Maybe you are sitting on that. If I ask you to lift that chair using your muscle power today, you would easily do. But the same chair, if I would have asked you to lift when you were 2 years small kid, you would not have been able to do. You would wonder with one thing, If you ask a 2-year small child, then why are you not able to lift the chair? Do you know, the child would never say that the child does not have strength. Child would never say that child does not have strength. Child would always say that the chair is too heavy. The chair is heavy. So that child, when it is becoming bigger and bigger and now reaching your age, now if I ask you to lift that same chair, you won't say that it is heavy and you will easily lift it. So can you imagine, around 20 years back when you were 2 years old, you were not able to lift the chair, now you are able to do. What has changed? Has the weight of chair got reduced, or your capacity to lift that burden has risen up? You would obviously agree that the weight or the burden of the chair has not reduced. It is your capacity to lift that weight has become better, and therefore the chair appears to be lighter. Lifting that chair becomes an easier task because you have enough strength to lift that chair. That is what the concept of leverage, and that is where the measure of leverage is not an absolute measure, it's a relative measure. That is why it is measured through a ratio. So in the column first, we are finding degree of operating leverage as 6 times. When the same thing is taken to fourth column, you find degree of operating leverage just 2 times. So higher the degree of operating leverage, more is the operating risk. The obvious reason is what? The amount of fixed cost is not very high. Your capacity to lift that fixed cost in the form of contribution is little low. That is why the burden of fixed cost appears to be high. So it is always a relative measure. So you have to always look into contribution divided by EBIT as a measure of relative risk, which we call as degree of operating leverage. And on the same lines, if you focus on this statement, interest is the other factor which is causing risk, right? Interest is another factor. What comes before interest is EBIT. What comes after interest is EBT. So if you now take the ratio of EBIT divided by EBT, it will become degree of financial leverage. Same logic what we have learnt earlier. Now if you combine both the factors of risk, that is fixed operating cost as well as interest, both taken together, the component before that is contribution and the component after that will be EBT. So component before fixed cost or fixed operating cost is contribution, and component after interest is EBT. So when you take contribution divided by EBT, you will be getting the measure of risk, which is a combination of operating and financial risk both. That is why it is called degree of combined leverage, and through mathematical calculations, DOL multiplied by DFL will eventually give you DCL, that is degree of combined leverage. Let us do one thing, let us finish out those calculations and then we will explore more with the concepts of leverages. So please pay attention on the screen. I'll take you ahead and show the other calculations which are demanded in the question. So for all the 4 cases, you were supposed to compute degree of operating leverage, that is contribution divided by EBIT. So 6 times, 3.5 times, 2.67 times and 2 times is what you are getting. So as and when you are having more and more sales, your operating risk appears to be lesser and lesser, only and only because of one factor, not that your burden of fixed cost has reduced, but your capacity to bear that burden has increased. Same thing happens with degree of financial leverage, 10 times, 1.82 times, 1.43 times and 1.22 times. And same thing happens obviously with combined leverage also. And you can see as and when your sales are improving, your contribution is improving, your capacity to bear the burden of costs is getting better and better, and therefore the measures of leverages are getting lower and lower, indicating lower risk as compared to what it was earlier. Now for a better understanding, let me take you back to the previous table. so that I can offer some additional explanation on leverages. Everyone's attention over here once again, please. Can you notice one thing? Again, if we pay attention on the very first column, look at this part. EBIT is 2 lakhs, interest is 1,80,000 and EBT is only 20,000. If you focus on this interest as one risk factor, which is indicating a financial risk, the existence of this interest cost is clear indication of financial risk. Now, this financial risk being a fixed type of cost, in all the columns it is same. So, if I ask you to measure how much is the risk in case 1, you would say, sir, 1,80,000. What about case 2? You would say, sir, still 1,80,000. What about case 3? Oh my God, still 1,80,000. And case 4, again 1,80,000. So, looking at these absolute amounts, we are not able to gauge where is the risk less and where is the risk more. So, I have explained you one logic, that the existence of risk is not because of the amount itself, but instead by the capacity to lift the burden of that amount. So, fine, 2 lakhs is EBIT and out of that 1,80,000 is spent only on account of interest. So, what remains with you is just 20,000. So, out of 2 lakhs of EBIT, after payment of interest, what is the income remaining in your hand? Just 20,000. So, what indication do we get from here? That if you want to earn 20,000, you must generate EBIT of 2 lakhs. If you want to earn 20,000, you must generate EBIT of 20 lakhs. So, if I relate these two on a ratio basis, 20,000 of EBT would require 2 lakhs of EBIT, 20,000 of EBT would require 2 lakhs of EBIT. So, how much would be required EBIT for every 1 rupee of EBT? So, if 20,000 of EBT requires 2 lakhs of EBIT, 1 rupee of EBT will require 10 rupees of EBIT. That is the implication of degree of financial leverage. That means the requirement to generate EBIT is 10 times of the EBT that you want, because this huge amount is a burden of interest over here. Let me take you now to this last column. Have you noticed in the last column what is happening? To generate 8,20,000 of EBT, how much of EBIT you want? You want EBIT of 10 lakhs, that's all. So, a little extra burden you can easily bear. So, for having 8,20,000 of EBT, your required EBIT is only 10 lakhs. As a result, if you find this ratio, it is not something like 10 times. It is 1 point something, right? What does that indicate? That the financial risk over here in this column was substantially lower than what we have noticed in the first case. But what did change over here? What has changed over here is not the amount of interest. It is same all throughout. What has actually changed is the capacity to lift the burden of that interest cost, which was in the form of EBIT. Now look at one thing. Fixed cost has one component before it as contribution and another component after it as EBIT. Interest has one component before it as EBIT and one component after it as EBT. Some students might have doubt, why are we taking this ratio? We are taking this ratio to find the gap between the two, but the gap cannot be measured on absolute basis, because absolute calculations will not give you any hint of risk, because it is in all columns 1,80,000, 1,80,000. That is why we would want to find the gap between the two on relative basis. The moment you want to find the gap between the two on relative basis, the best thing is to compute a ratio of EBIT upon EBT. So, when you take EBIT upon EBT, What is the factor which is arising as a gap? Interest, which is hint of financial risk. That is why EBIT upon EBT is degree of financial leverage. Likewise, when you try to take contribution divided by EBIT, that ratio is giving you a gap, a relative gap towards fixed cost, correct? Because fixed cost is coming in between contribution and EBIT. So that ratio of contribution divided by EBIT gives you a relative impact of fixed cost into existence. Therefore, contribution divided by EBIT will give you degree of operating leverage, which is a measure of operating risk. If I combine both of these, so one side it is a fixed cost, there is fixed operating cost that causes risk, another side it is interest amount that is causing risk. Combine these two, what is the ratio that you need to take? So if you take the combined effect of fixed cost and interest, the factor before that was contribution and the factor after that is EBT. So taking the contribution divided by EBT ratio would give you measure of overall risk, which is termed as, in terms of ratio, it is termed as degree of combined leverage or DCL. So I am sure first of all whatever we have discussed by far you have clearly understood, and now for clarification of some more points of doubt, let me put forward this particular explanation. Please carefully listen to me. See, one thing, just imagine that you have contribution of 10 lakhs and you have fixed operating cost also 10 lakhs. 10 lakhs of fixed operating cost and 10 lakhs of contribution. Do you know what will happen? Your EBIT will become 0. Fine. Is that a high risky position? 100% yes. It will be a very high risky position. Why? Because if you try to measure degree of operating leverage by taking contribution divided by EBIT, contribution amount was 10 lakhs, EBIT is 0, anything divided by 0 will give you infinite value. That means you have such a high degree of operating risk that even cannot be measured. You have infinite operating risk over there. In such case, if you have taken loan also, if you have taken borrowings also, and you have commitment to pay interest, your EBIT is already 0, your EBT will turn to be a negative value. Means you have to pay interest and that will create a loss. So here what will happen? Your EBT will go to negative. In that case, when you try calculating your degree of financial leverage, the result will be 0 divided by a negative number and you would get a negative value. So please understand, when you are computing any type of degree of leverages, that is DOL, DFL or DCL, any type, if the numerator or denominator anything is either 0 or negative, it clarifies one thing, that it will give you infinite risk. So even if any component is negative, it is indication of infinite risk. In that case, suppose I tell you that your EBIT is 0 and interest is 2 lakhs, so EBT will be minus 2 lakhs. I ask you to calculate DFL. So don't write 0 by minus 2 lakhs equals to 0. Don't write that as 0. It is indication of infinite risk. So please carefully understand this point. And keep it into your notice that when your numerator or denominator, any one component also, is either 0 or negative, it indicates infinite risk. Actually speaking, degree of any leverage should never be expressed less than 1. It should never be expressed less than 1. I'll give you one simple example. Imagine a scenario with 0 financial risk. When will a situation happen when there is no financial risk at all? when suppose you have not borrowed a single rupee. No borrowings, no commitment towards interest cost. If you don't have to pay any interest, what will happen? EBIT, it is suppose 10 lakhs, interest is 0, EBT will also be 10 lakhs. That time you try computing your degree of financial leverage, EBIT divided by EBT, 10 lakhs by 10 lakhs, the result will be 1. Your DFL cannot be lower than 1. If it is 0 or negative value in numerator or denominator and you are getting a hint of 0 or a negative calculation, it is never possible that it will be a 0 or negative calculation. In that case, the final end result of your DFL should be written with an infinite sign. I hope what I have just discussed with you is crystal clear to all of you and you don't have any doubts further. Establishing interrelationship of leverages with other factors. Let us move ahead. Consider the following example. Let me tell you, this example hasn't ended yet. So let us move ahead and write the same thing further. If sales increase by 5 lakhs. So now what you have to do is, you have to redraft your income statement when sales are increasing by 5 lakhs. Other things remaining same. For example, the variable cost ratio would remain same. The contribution and variable cost by amount will change, fixed cost amount will remain same, and the resulting EBIT, it will change. Sales 15 lakhs, now variable cost will be 6 lakhs, contribution is 9 lakhs, fixed cost remains 3 lakhs, earnings before interest and tax, it is now 6 lakhs. So EBIT is 6 lakhs. And what is this example asking you to do? You are required to establish interrelationship of leverages with other factors. Now over here, I want everyone's attention. Please look into this matter and let me ask you certain questions. Please observe one thing, that sales have increased from 10 lakhs to 15 lakhs. Sales has increased by 5 lakhs, means it has increased from 10 lakhs to 15 lakhs. The base of the sale was 10 lakhs, it has increased by 5 lakhs. Can we call it an increase by 50%? Yes or no? Sales have increased by 50%. Use your common sense now that variable costs are directly linked with the sales. So if sales increase by 50%, logically variable cost will also increase by 50%. Yes or no? Variable cost will also increase by 50%. And as a result, contribution will also increase by 50%. If you don't believe me, you can check on your own with the calculations that you have made. Earlier the contribution was 6 lakhs. Now the contribution is 9 lakhs. So contribution has increased by 50%. So let us try to conclude this point. Whenever sales increases by certain percentage, variable cost as well as contribution will always increase by same percentage. Whenever sales decrease by certain percentage, variable cost as well as contribution will also decrease by same percentage. However, the fixed operating cost over here is a fixed component of cost that is not changing. In this example, earlier it was 3 lakhs, now also it is 3 lakhs. Because this component does not change, it will disturb your 50% changes. What I am trying to say is, right from sales, everything is changing 50%. One component did not change at all. It will create an impact on upcoming components. So what comes after fixed operating cost? It is EBIT. Now EBIT has not increased by 50%. EBIT has increased by 100%. Did you observe over here? Earlier EBIT was 3 lakhs, now EBIT is 6 lakhs. So EBIT has doubled up. When I say doubled up means it has increased by 100%. And do you know the interrelationship over here? Contribution has increased by 50%. Degree of operating leverage originally in this example was 2 times. When you multiply that 2 times to this 50%, that will give you increase in EBIT. Now this is what we have to learn now, that when sales increase by 50%, variable cost also increase by 50%, contribution also increase by 50%, but EBIT will not increase by 50%, it will increase by a higher percentage. How much higher percentage? 2 times. And from where did we draw this 2 times? That was the role of degree of operating leverage. So now understand this notion. If contribution is increasing by 50% and degree of operating leverage is 2 times, EBIT is bound to increase by 100%. So let us do one thing. Let us first write up this analysis and then we shall talk ahead. Establishing interrelationship among leverage and other factors. Referring the example given above, we can conclude the following. Number 1, percentage increase in sales is equal to percentage increase in contribution, and that is equal to 50%. Second observation that we have is fixed cost does not change. Therefore, EBIT increase by a higher percentage, and if we quantify that, percentage increase in EBIT is twice the percentage increase in contribution. Therefore, it can be concluded that the percentage increase in EBIT is basically percentage increase in contribution multiplied by DOL. If you can again relate, percentage increase in EBIT, what we have found was 100%, whereas percentage increase in contribution was only 50% and DOL was 2 times. So this is the interrelationship that we have extracted from this example, that percentage increase in EBIT equals to percentage increase in contribution multiplied to DOL. You would be wondering that there are stupid people across the universe who consider this as formula and keep mugging up, whereas they fail to understand that these are so simple concepts that can emerge out of small examples like this. And now mathematically, if I ask you to find value of DOL, what you will do? You would simply take percentage increase in EBIT divided by percentage increase in contribution. If you try to calculate DOL, that is degree of operating leverage, through the above equation, it will be percentage increase in EBIT divided by percentage increase in contribution. So originally DOL was contribution divided by EBIT, but if you check the calculation through this kind of percentage increase or decrease, in the numerator you would take the percentage increase in EBIT and the denominator will be percentage increase in contribution. This is just another way that you can compute degree of operating leverage. I don't want you people to mug up the formulas. I want you to develop understanding out of this. The way we have discussed this example and established the interrelationship with operating leverage, I want you to apply same concept and write the calculation for degree of financial leverage. So similarly, percentage increase in EBT will be percentage increase in EBIT multiplied by DFL. So DFL can be determined as percentage increase in EBT divided by percentage increase in EBIT. So similarly, percentage increase in EBT can be worked out as percentage increase in contribution multiplied by DCL. Therefore, DCL can be worked out as percentage increase in EBT divided by percentage increase in contribution. Let us move ahead and now write up one another relationship which is very, very important. It is considered that overall risk is a combined effect of operating risk and financial risk. Therefore, DCL is a product of DOL and DFL. So when you multiply DOL and DFL, you indeed multiply contribution divided by EBIT into EBIT divided by EBT. So mathematically, EBIT in the denominator in the first expression gets cross cancelled against the EBIT in the numerator in the second expression, and what we get as DOL into DFL equal to contribution divided by EBT, and contribution divided by EBT is nothing but degree of combined leverage. So we have mathematically proven that DOL into DFL will be DCL. Let us move ahead and take up a calculative example that is given as question number 3 in your book. Let us read this question. The total fixed operating cost of Incito Limited is rupees 60,000. Annual interest payable is rupees 20,000 and the variable cost is 80% of sales. Prepare income statement of the company and calculate various leverages under the following situations. Number 1, when sales is rupees 6 lakhs, and number 2, when sales is rupees 9 lakhs. The question is further asking you also indicate the changes in EBIT and EBT with respect to changes in sales, that is when sales increase from 6 lakhs to 9 lakhs and when sales decrease from 9 lakhs to 6 lakhs. So let us do one thing. Let us see how to present the solution, because as such in this question there is no new component to be discussed or explained. It is just about application of concepts that you have already learned. So in terms of presenting your solution, you get started with income statement for the two cases when sales are 6 lakhs and 9 lakhs. Subtract the variable cost to arrive at the contribution, and variable cost is reported as 80% of sales value. So contribution will be 20% of sales. From contribution subtract fixed cost and what you get is EBIT less interest, that will be 20,000 in each case, resulting into EBT of 40,000 and 1 lakh. Let us move ahead and make the calculation of leverages for both the cases. DOL is contribution upon EBIT, that will be 2 times and 1.5 times. DFL will be EBIT upon EBT, that is 1.5 times and 1.2 times. And DCL is contribution divided by EBT, that will be 3 times and 1.8 times. Let us move ahead and deal with that analytical part, that is effect of change in sales. Case 1, when sales increase from 6 lakhs to 9 lakhs, sales is increasing by 50%. So we know that contribution will also increase by 50%. Now we know one thing that we have learned from the earlier content. Increase in EBIT will be percentage increase in contribution multiplied by DOL. So that will be 2 times multiplied to 50% and that will be 100%. So EBIT increases by 100%. And you can verify from the income statement of case 1 and case 2 that when you switch over from case 1 to case 2, that is when sales increase from 6 lakhs to 9 lakhs, your EBIT is increasing by 100%. Can you check? Your EBIT in the first statement is 60,000 and in your second column it is 1,20,000. So if EBIT is increasing from 60,000 to 1,20,000, it is clear that EBIT is increasing by 100%. So when you are applying this concept, it will always apply unbeaten, because this is the core concept of leverage. Let us move ahead and write up the other part of analysis. What we have further learned is percentage increase in EBT will be percentage increase in EBIT multiplied by DFL. So here percentage increase in EBIT is 100% and DFL is 1.5 times, and therefore what we get is percentage increase in EBT as 150%. You can verify this from the income statement. Originally in case 1 your EBT was 40,000 and in case 2 your EBT is 1 lakh. So EBT is increasing by rupees 60,000 and 60,000 is nothing but 150% of 40,000. So it is increasing by 150%, and the same thing can be verified from yet another interrelationship that we have learnt, that is percentage increase in EBT equals to percentage increase in contribution multiplied by DCL. So it will be 50% into 3 times, and what we get finally is 150%. So EBT increases by 150%. Let us move ahead and deal with the second situation when sale decrease from 9 lakhs to 6 lakhs. So for this purpose, consider the 9 lakh column, the second column, as the base column, and start recording the changes in various factors when the sales decrease from 9 lakhs to 6 lakhs. Everything will be applied exactly in the same way, only the difference is the change over here is not in terms of increase but in terms of decrease. So I don't have to explain you again, just understand and write it properly. So if contribution and sales are decreasing by 33.33%, the reduction in EBIT will be by a greater value, and that comes to 50%, which is 1.5 times of 33 1/3%. Let us move ahead and deal with the later calculations. So the percentage decrease in EBT will be percentage decrease in EBIT multiplied by DFL. Percentage decrease in EBIT is 50% and DFL is 1.2 times. So percentage decrease in EBT is 60%. If you can relate it from the income statement, considering second column as your base, that is second case as your base, in that second column EBT is 1 lakh and now it is changing to 40,000, so it is reducing by 60%. The same thing can further be verified by applying this equation, that percentage decrease in EBT will be equal to percentage decrease in contribution multiplied by DCL. So that will be 33.33% into 1.8 times, that would also give you 60%. Conclusion is EBT decreases by 60%.